in past generations, people have actually managed to save large sums of money by not being aggressive on their investment strategy. There are people who invested, for example, whole hog into the Provident Fund, and they built a large corpus. Is that possible anymore? I know the answer is no based on the rates that we're seeing right now, but how do you communicate that? The need to take risk so that you can build a sizable corpus and beat inflation consistently, and also have the option down the line, as you've just pointed out, to reach that critical mass.
I think the way to think about this is, it is still possible for a smaller subset of people who have a reasonably large amount of wealth to run very fixed income oriented portfolios and still get to their goals. But they may end up reaching a point at some stage in their retirement that they feel that their money has not worked hard enough for them. And I think one of the things that we are all very mindful of in terms of a shift that has happened is the amount of, medical technology shifts that are taking place. So I think the chances of living long, even if it's not necessarily in a very healthy manner, is suddenly a reality. And therefore, one does end up in a situation where one is maybe forced to look at taking some element of risk in the portfolio. So I think there's a need to understand that risk very often just may mean volatility, which means that your portfolio values could be going up and down along this long journey of retirement. And it doesn't mean that you're going to be forced to sell when the prices are low. So I think a lot of this is about portfolio strategy. How do you sort of not become too equity heavy, at the same time not depend on equity returns to support your next month's expenses or next year's expenses? So you can actually build out a bucket amongst groups of your investments, saying that this is my money for the next 5 years. Maybe I just put that in very safe instruments. For money which is required over the next 5 to 10 years, I can have a combination of some slightly more aggressive instruments and less aggressive instruments. And then when there's money required for maybe from 70 to 80 or the later stage of my retirement, I can afford to take this risk today because I have time on my side to cover for the volatility that come in. Because ultimately, real rates of return need to happen for your retirement to really be comfortable for you.
Disclaimers: investment in securities market are subject to market risks. Read all the related documents carefully before investing.